The founders sit in a room and they agree to sell pieces of their company to complete strangers, people they will never meet, people who had nothing to do with building what they built, and they do it willingly. If that sounds strange to you, good, it should, because nobody ever explains why, and once you understand the real reasons, you will never look at a stock, a share price, or a company announcement the same way again. By the end of this video, you will know exactly why companies go public, what they are actually trying to achieve when they do, and, most importantly, what it means for your money, whether you have been investing for years or you have never bought a single share in your life. But I want to warn you about something before we get into it. There is one reason companies go public that almost nobody talks about, and it is the one that should matter most to you as an investor. I am saving it for the end because once you hear it, everything else will click into place. Let's get into it. Every single day, somewhere in the world, a company makes a decision that will change it forever. The founders sit in a room and they agree to sell pieces of their company to complete strangers, people they will never meet, people who had nothing to do with building what they built, and they do it willingly. If that sounds strange to you, good, it should, because nobody ever explains why, and once you understand the real reasons, you will never look at a stock, a share price, or a company announcement the same way again. By the end of this video, you will know exactly why companies go public, what they are actually trying to achieve when they do, and, most importantly, what it means for your money, whether you have been investing for years or you have never bought a single share in your life. But I want to warn you about something before we get into it. There is one reason companies go public that almost nobody talks about, and it is the one that should matter most to you as an investor. I am saving it for the end because once you hear it, everything else will click into place. Let's get into it.
So, why does a company make that leap? Why give up that complete ownership and open the doors to strangers? The first reason is the most straightforward, and it is the one you have probably heard. They need capital, money, a very large amount of it, faster than any other method can provide. Here's the thing about building a business. At a certain point, private funding hits a ceiling. Yes, you can borrow from banks. Yes, you can bring in venture capitalists. Those are professional investors who fund early-stage companies in exchange for ownership. Yes, you can find private equity firms. But every one of those sources has limits. Banks want collateral and charge interest. Venture capitalists want enormous returns and come with significant influence over your decisions. Private equity deals take months to negotiate. The public market has none of those ceilings. When a company lists on a stock exchange, in the US that is primarily the New York Stock Exchange or the NASDAQ, it is suddenly accessible to millions of buyers simultaneously. The amount of capital available is, for practical purposes, incomparably larger than anything the private world can offer. Imagine you need to renovate your home urgently. Every private lender you approach caps you at $50,000. Not enough. Going public is the equivalent of opening your front door and having 1 million people each willing to hand you a small amount. Suddenly, the ceiling disappears. The numbers vary by country. In the US, a mid-sized IPO might raise hundreds of millions of dollars, but the principle is identical wherever you are watching this. And critically, this is not a loan. The company does not pay it back. In exchange for that capital, investors receive shares, ownership. That distinction matters enormously, and we'll come back to it. But money is the obvious reason. The second reason is one most people completely overlook.
Picture this. You joined a startup 5 years ago. They could not pay you market salary, so instead they offered you something called stock options, the right to buy shares in the company at a fixed price once certain conditions are met. You believed in the product, you took the deal, and now, 5 years later, the company is genuinely valuable. Your options are worth, on paper, several $100,000. On paper. Because the company is still private, there is no market for those shares. You cannot sell them to anyone. You cannot walk into a bank and use them as collateral for a loan. You cannot convert them into cash to pay your rent or buy a home. You are, in the most frustrating way possible, wealthy and broke at the same time.
This is called the liquidity problem, and it is not just your problem. It is the problem of every early investor, every venture capitalist, every angel investor who put money into this company years ago. They are all sitting on value they cannot access. An IPO solves this in one move. The moment a company lists publicly, those shares have a market. There are buyers. The locked door opens. Think of it like holding a concert ticket for the most exclusive show in the world, except the venue has no exit. The ticket is worth a fortune, but you cannot leave and you cannot sell it. The IPO is the moment they finally open the doors. Now, and this is important, this means that when you hear about an IPO raising, say, $500 million, not all of that money goes to the company. A significant portion often goes directly to early investors and founders who are selling their existing shares. In the U.S., this information is publicly available in the IPO prospectus filed with the SEC, the Securities and Exchange Commission. In other countries, equivalent regulators require the same disclosure. Always check where the money is actually going. That single habit separates informed investors from everyone else. This is the part most people miss, and it brings us to reason 3.
Here is something that surprises almost everyone when they first hear it. Going public does not just give a company money, it gives a company power. A specific, underappreciated kind of power. When your shares are listed on a public exchange and trading at a certain price, those shares have a real, agreed-upon market value that the entire world can see. And that means your shares are now effectively a currency. Let me make that concrete. Imagine Company A is publicly listed and its shares are trading well. Company B, a smaller competitor, is doing interesting work that Company A wants to absorb. Instead of spending $200 million in cash to acquire Company B, Company A can offer Company B's shares in Company A instead. No cash leaves the building. The deal gets done with stock. This is called a stock-for-stock acquisition, and it is one of the primary engines of how large companies grow. In the U.S., some of the biggest deals in corporate history have been structured this way. Without a public listing, this mechanism simply does not exist. There is a second layer to this credibility point. A publicly listed company carries a different weight in the room. Banks extend larger credit lines more readily. Major enterprise clients, the kind that sign multi-year contracts worth tens of millions of dollars, feel safer partnering with a public company because the financials are transparent and regulated. Recruiting top talent becomes easier. The SEC in the U.S. and equivalent bodies globally require public companies to disclose financial results on a regular schedule, and that transparency, paradoxically, becomes a competitive asset. Here is a question I want you to sit with and drop your answer in the comments. If you had spent 10 years building a company from nothing, would you take it public, or would you keep full control and find another way to grow? I personally reply to the most interesting answers. Because the answer to that question depends entirely on what I am about to tell you next.
Now, the part I promised you at the start, the part most financial content skips entirely. Going public has a cost, a real one, and it is not the legal fees or the underwriting costs, though those are significant. The real cost is something founders feel every single day after the IPO closes. When your company is private, you answer to a small, specific group of people, your co-founders, your investors, maybe your board. They all have a long-term stake in the business. They can absorb a bad quarter. They can support a bold 3-year strategy even if it hurts short-term numbers. They knew what they were signing up for. The moment you go public, you answer to the market. And the market, millions of shareholders, many of whom bought your stock this morning and may sell it this afternoon, has a very short memory and a very short temper. Every 3 months, public companies in the U.S. are required to report their financial results. This is called a quarterly earnings report. Miss the numbers that analysts expected, even by a small margin, your stock price can drop 10%, 15%, 20% in a single day. That drop is not just a number on a screen. It affects employee morale, recruiting, acquisition currency, and the founder's own net worth. Here is something most financial content will never tell you. Some of the most disciplined, visionary founders in business history deliberately avoided going public for as long as they possibly could, not because they lacked the ability to list, because they understood that short-term shareholder pressure and long-term vision are often in direct conflict, and they were not willing to compromise the vision. This is the edge most people never develop, because they were simply never taught this. When you see an IPO announced, the crowd cheers. The informed investor asks, why now? Who benefits most from this timing?
So let's bring this home, because everything we just covered only matters if you can use it. You now know that companies go public for 4 distinct reasons: to raise large amounts of capital without taking on debt, to give early investors and employees a way to convert paper ownership into real money, to gain credibility and a powerful acquisition currency, and sometimes because the pressure from early backers who want their exit simply becomes impossible to ignore. Each of those reasons tells you something different about the company's situation, and as someone building your own financial future, whether you are just starting out or already have money in the market, knowing which reason is driving a specific IPO is one of the most useful filters you can develop. Here is your action step for this week. Pick any company that went public in the last 2 or 3 years, one you have actually heard of. Go find their IPO prospectus. In the US, it is called an S-1 filing, and it is completely free on the SEC's EDGAR database at sec.gov. In the UK, Canada, Australia, and most other markets, the equivalent document is filed with your local regulator and is equally public. Find the section called Use of Proceeds. It will tell you exactly where the money raised actually went, how much went to the company, how much went to insiders selling their shares. What you find might genuinely surprise you, and it will change how you read every IPO announcement from this point forward. That's the edge. It was always available. You just needed someone to point you at the right door.
Before you go, one question I genuinely want your answer to. Based on everything you just learned, do you think IPOs are better for the company going public or for the early investors getting out? Leave your answer below. There is no wrong answer here. I want to see how you think. If this video gave you a clearer picture of how the market actually works, hit the like button. It takes 1 second and it helps this reach people who need it. And if you want to keep building this kind of financial clarity, one concept at a time, no jargon, no fluff, subscribe. This is exactly what we do here. I will see you in the next one.